Good morning, everyone. As the designated federal officer for the Global Markets Advisory Committee, it is my pleasure to call this meeting to order. I'd like to welcome everyone to today's meeting. This is the first Gmac of 2020 and the third under the sponsorship of Commissioner Stump. In light of the global response to COVID-19, we are holding today's meeting as a virtual meeting to protect the safety of agency personnel, Gmac members, subcommittee members, presenters, and the public. While this is not how we envisioned holding our first meeting of 2020, we are grateful for the chance to come together in a way that ensures everyone's health and safety. To ensure that today's meeting goes as smoothly as possible, there are a few logistical items that I need to mention. Because this is a virtual meeting, it is also being broadcast in a live stream on the internet, so please be sure to identify yourself before speaking. Also, please signal when you have completed your comments so we can continue with the next speaker or question. Please ensure that your phone is unmuted before you start to speak, that you speak clearly into your phone, and that you remute your line when you are done speaking. For Gmac members and commissioners, if you would like to be recognized during the discussion, please use the WebEx chat icon at the bottom of the screen, then select the All Panelists option within the drop-down menu, indicate that you have a comment or question, and press Enter. For any subcommittee member, please just unmute your phone if you would like to speak. If any meeting participant needs assistance during the call, please dial *0 to connect to the conference operator. Finally, please keep your telephone line muted when you are not speaking. If you do not mute your line, the conference operator may need to mute it for you. I'd now like to turn it over to the Gmac sponsor, Commissioner Dawn Stump, for her opening remarks.
Thank you, Andre. This is Commissioner Stump. Good morning to everyone, and I also want to welcome you all. Certainly, I should acknowledge that this meeting looks much different than I had envisioned even just a few short months ago. And while we're not able to gather in the same room, I am grateful that we can hold these types of discussions and move forward the Gmac priorities in a format that ensures the health and safety of the Gmac members, the Commission staff, and the public. Simply put, the markets we regulate are global in nature. This always seems to become more apparent in the midst of difficult times. Yet we work with our regulatory counterparts around the world constantly. Certainly these relationships serve to improve responses in unsettled times, but we should not forget that they also serve us well in less eventful times. I hope that when we emerge from the current pandemic, this spirit of cooperation will remain evident. Market regulators around the globe are undeniably linked, in good times and in challenging times. I would like to take the opportunity to thank Chairman Tarbert for his leadership on global coordination and my fellow commissioners for their efforts to cultivate productive relationships with our counterparts around the globe. I very much appreciate their attendance at today's meeting and their contributions to the discussion. I would also like to thank the Gmac members for sharing their expertise of navigating the regulations applied to these global markets. We are very fortunate to have such expertise as we engage in today's discussion. In addition, I would like to extend a special thanks to today's presenters, Mr. Suyash Paliwal and Ms. Wendy Yoon. Finally, I would like to thank Andre Goldsmith, the Gmac designated federal officer, for organizing today's meeting, and Chair Angie Karna for her leadership of the Gmac. The first presentation today is from Suyash Paliwal, Director of the CFTC's Office of International Affairs, and will focus on coordination efforts among the international regulatory community in the face of recent market events. The COVID-19 pandemic has affected economies all over the globe, and Mr. Paliwal and his team have been key players in engaging with international coordination efforts during this unprecedented period of market volatility. The international regulatory community has come together to address the challenges caused by the global pandemic, and the CFTC has played a leadership role in these endeavors under the leadership of Chairman Tarbert and Director Paliwal. Next, we will turn to the work of the Gmac Subcommittee on Margin Requirements for Non-Cleared Swaps. Following the last Gmac meeting in September, during which the Gmac heard several presentations on the unique challenges posed by the latter implementation phases of margin requirements for non-cleared swaps, the Commission established this subcommittee. In our public solicitation for subcommittee nominations, it became obvious that the interest in this matter is vast and the viewpoints are many. It is therefore remarkable that such a diverse group of representatives was able to deliver a report to the committee in a relatively compressed time frame, further complemented by an unprecedented global pandemic. The subcommittee mandate was to examine the implementation of margin requirements for non-cleared swaps, to identify challenges associated with forthcoming implementation phases, and to recommend actions the Commission may take to mitigate any challenges identified. The subcommittee took that mandate and ran with it. In just a few short months, the subcommittee has prepared a detailed report outlining several unique challenges posed by the upcoming implementation phases and recommending a number of specific potential actions to mitigate these challenges. The subcommittee is to be commended for continuing its hard work even as its members were responding to recent market events and the timing of margin requirements was evolving within the BCBS and IOSCO. In short, the efforts to get this report before the committee today was no small task. I know the full Gmac has carefully considered its content and is prepared to discuss today. I want to thank especially Warren Borlick and Carmen Mancada-Terry from the CFTC's Division of Swap Dealer and Intermediary Oversight for their engagement with the subcommittee. I also want to offer appreciation to each member of the subcommittee, and especially Subcommittee Chair Wendy Yoon for her leadership. I am so pleased that many of you could attend this meeting today, and I look forward to hearing the presentation. With that, I will turn things back to Andre and Angie. Thank you.
Thank you, Commissioner Stump. Chairman Tarbert.
Good morning, everyone. It's a privilege to be here today with the members of the Global Markets Advisory Committee and its subcommittee on margin requirements for non-cleared swaps. I'd particularly like to commend and thank Commissioner Stump for her leadership in sponsoring and supporting the important work of the Gmac and its subcommittee. Thank you also to Andre Goldsmith for her diligent work as the Gmac's designated federal officer. I, of course, also want to express my appreciation to Angie Karna for continuing to serve as Gmac chair, and to Wendy Yoon for serving as the chair of the Gmac's Margin Subcommittee. To both of you and all the members of the Gmac and the Margin Subcommittee, thank you for giving your limited time and invaluable insights to us. Your contributions are critical to helping the CFTC pursue its mission to promote the integrity, resilience, and vibrancy of the U.S. derivatives markets through sound regulation. Very much look forward to today's presentations. I'm pleased that Suyash Paliwal, our Director of the Office of International Affairs, will be speaking about international coordination in the wake of the COVID-19 pandemic. I'm also particularly looking forward to the Margin Subcommittee's presentation on its report and recommendations for margin requirements for non-cleared swaps. As a threshold matter, I agree with the report's recommendation to extend the compliance deadline for phases 5 and 6 of the margin requirements by a year in response to COVID-19. As the Basel Committee and IOSCO has also basically supported this extension, and they did so because it allows firms to dedicate the necessary operational resources to their COVID-19 response and business continuity efforts. And I also want to point out that several regulators abroad have already taken steps to implement this relief. As I've said before, I believe the CFTC's margin rules are a key systemic risk mitigant. However, the market participants receiving the extension are only those with the smallest uncleared swaps portfolios. So we're essentially balancing the critical need to marshal scarce operational resources for COVID-19 against the relatively small risk posed by a one-year compliance delay. So as a result, I believe the CFTC should follow the international counterparts in granting that extension, and this measure is on our near-term agenda, and I hope the Commission will vote on it in short order. More generally, the subcommittee should be proud of having produced a comprehensive and thoughtful set of recommendations in this report. I particularly appreciate that a number of the recommendations suggested multiple alternative ways of accomplishing the objectives. So this is a kind of flexible, practicable thinking that is incredibly helpful to the CFTC as we determine how to address the issues that were readily identified in the report. In that regard, I know that Warren Gorlick and Carmen Moncada-Terry of the CFTC's Division of Swap Dealer and Intermediary Oversight were very helpful to the subcommittee's work in producing the report and will continue to contribute to their extensive expertise as we digest and react. And I can tell you that I met actually with Warren and Carmen last week to discuss the recommendations and whether there were any that we could implement in short order. So Warren and Carmen, thank you as always for your dedication on these issues. I look forward to hearing more from the presenters about the issues and working with my fellow commissioners, CFTC staff, and Gmac members to pursue our sound commitment to derivatives regulation in a sound manner. So thank you all very much. Great to be here this morning.
Thank you, Chairman Tarbert. Commissioner Quinten?
Thank you, and good morning, everyone. Thank you to Commissioner Stump for convening today's meeting, as well as Andre and Angie for your leadership. I, too, am looking forward to hearing the presentations from our own Suyash Paliwal, as well as the Gmac subcommittee. And just a few thoughts on the on UMR. We're now in the final implementation stages of the margin framework for uncleared swaps. And in 2019, one survey found that the 20 largest market participants, the phase one firms, had collected approximately $173 billion of initial margin for their non-cleared derivatives transactions. Collectively, phases 1 through 4 firms, market participants captured by phases 1 through 4, comprised approximately 89% of the total average aggregate notional amount of swaps across all phases, with the remaining phases of 5 and 6 comprising only 11% of notional amount, but representing approximately 94% of all entities brought into the uncleared margin regime. Given the large number of firms brought into scope during phases 5 and 6, and the estimated 7,000 initial margin relationships that need to be negotiated, as well as the small overall percentage of swap activity covered by these firms, or that these firms represent, I believe it's important to implement these final phases in the most responsible, least burdensome way. So I'm extremely interested to hear from the subcommittee regarding their thoughts and recommendations. In particular, looking forward to learning more about providing possible relief from initial margin calculations for small covered swap entities, providing compliance grace periods to allow firms time to establish the necessary custodial documentation after the initial margin threshold has been exceeded, and aligning the timing and methodology for the material swaps exposure calculation with the Global Basel Committee on Banking Supervision and IOSCO framework. In closing, I'd like to thank all of today's presenters, as well as the Gmac membership, and again, to Commissioner Stump, Andre, and Angie for organizing the meeting. Thank you.
Thank you, Commissioner Quinten. Commissioner Benham?
Good morning, everyone. Thanks, Andre. First off and foremost, of course, thanks to Commissioner Stump for her leadership as sponsor of the Gmac. Special thanks to Andre Goldsmith as DFO, Angie Karna for her leadership as chair, and Suyash for presenting today, and of course Wendy Yoon as chair of the subcommittee. Also recognize the CFTC staff who have participated on today's reports and the production of it. It's a fantastic report. Like the chairman said, and with all advisory committee reports, these are very valuable for the commission to consider. It just provides us such great depth and information about what the market's thinking, what challenges you're facing, and what we need to do as regulators to be flexible to both meet our mandate, but also allow markets to function smoothly and in a well-mannered way. I do want to just point out some issues about uncleared margin, which we're going to hear about today. Obviously, a huge part of the Dodd-Frank law and in the global reforms after the financial crisis, uncleared margin is a huge sort of critical foundational point of the reforms. But as we sort of have emerged into phase 5 and phase 6 now, I think it's both important that we move forward with it, but move forward with it in a smart, effective way so that we reduce operational risk, that we time these things well, and that we allow both our market participants, including end users, to use our markets freely, openly, and in a sort of efficient way. We need to, I think as regulators, to be able to oversee markets that are functioning well, but that ultimately we allow our market participants to use them for the purposes that they are set out to use. So looking forward to today's conversation. Again, big thanks to everyone who put this together and participated, is going to participate. And again, a special thanks to Commissioner Stump for her leadership. Looking forward to today's conversation. Thank you.
Thank you, Commissioner Benham. Commissioner Berkovitz?
Thank you. And thank you, Andre, and thank you, Commissioner Stump, for sponsoring this committee. Thank you, Angie Karna, for chairing the committee, and thanks to all the presenters today, Suyash and Wendy and others who will be speaking. In this time when we, as the chairman noted, 100% of the agency is teleworking, and certainly teleworking, I've been impressed by our ability and the dedication of our staff to our mission and under some very trying circumstances with kids at home and balancing all the additional responsibilities that people have to undertake in this extraordinary time in the face of some very serious and extraordinary challenges. But we have been able to keep focused on our mission and do our necessary work overseeing the markets and considering necessary improvements and reforms as previously. I would say, though, that from my personal experience, although we can meet and are meeting this challenge in this manner, it really doesn't substitute for a number of the face-to-face interactions that we have the privilege of when in normal times, and one of those is certainly advisory committee meetings and being able to sit at the table and interact and have both the formal conversations and informal conversations that go along with public meetings. So we'll get the job done, and we're getting the job done today, but I think there is a certain loss. And in that regard, it's absolutely critical that we have meetings like this, and we do stay informed, and we do hear from market participants, even if it's over the phone. So again, I want to thank Commissioner Stump and all the participants today. The situation with respect to initial margin has been noted, and certainly I supported the previous extension of the compliance framework. One question that I'm interested in this time is the extent to which, given the stresses on the economy, the credit risks are what the effect of increased counterparty credit risk in light of the economic downturn and the economic stresses that many sectors of the economy, the retail sector, the energy sector, transportation sector, given the increased credit risks in these various sectors, how does that affect the risks presented by to the intermediaries on uncleared swaps, and whether there's a cumulative greater counterparty credit risk component here that we should be considering as we consider these deadlines and the risks posed by these various sectors. So I think that's a question that I'm very interested in learning about it as we proceed to consider these margin requirements. So I'm very much looking forward to the discussion today, and thank you again for everyone who made this happen.
Thank you, Commissioner Berkovitz. Thanks again to all the commissioners for taking part in this meeting of the Gmac and for sharing your remarks with the committee. Before we begin with our presentations today, I would like to do a roll call of the Gmac members on the phone so that we have your attendance on the record. After I say your name and firm, please indicate that you are present. Chris Allen, Standard Chartered Bank.
Yes, I'm here. Hi.
Ted Backer, Morgan Stanley. Ashley Bellich, RBC Capital Markets. John Bernardo, TP ICAP Seth.
Good morning, I'm here.
Darcy Bradbury, DE Shaw & Co.
I'm here, thanks.
Maria Chiodi, Credit Suisse Securities.
Here. Thank you.
Clive Christensen, BP. Joe Suzuki, Better Market.
Yes, I'm here. Thank you.
Jim Colby, Coalition for Derivatives End Users. Jerry Corcoran, R.J. O'Brien and Associates. Sunil Coutinho, CME Clearing. David Goon, Intercontinental Exchange. Paul Hamill, Citadel Securities. Amy Hong, Goldman Sachs.
Present, thank you.
John Horkin, LCH Group.
Present.
Adam Kanzler, IHS Markit. Angie Karna, Nomura Securities International.
I'm here, thank you.
Robert Klein, Citigroup Global Markets.
I'm here. Good morning.
Agnes Ko, Singapore Exchange Limited.
Good morning, I'm here.
Ben McDonald, Bloomberg LP.
Good morning, I'm here.
Eric Tim Mueller, Eurex Clearing. Joe Nicosia, Louis Dreyfus Company. Murray Posmanter, DTCC.
Present, thank you.
Thomas Sexton, NFA.
Good morning. I'm here.
Jessica Soul, HC Technologies. Thane Twiggs, Cargo Risk Management.
I am present. Thank you.
Suparna Vedpet, BlackRock.
I'm here.
Masahiro Yamada, JP Morgan Securities. If any Gmac members were unable to indicate your presence on the call, please email me to confirm your attendance for the record. I'd now like to turn it over to Warren Gorlick, alternate designated federal officer for the Gmac Subcommittee on Margin Requirements for Non-Cleared Swaps, to conduct a roll call of the subcommittee members.
Thank you, Andre. This is Warren Gorlick. After I say your name, could you do the same as what Andre just did with respect to the Gmac members? So I'll just begin in alphabetical order. Mr. Mark Bailey, Two Sigma Investments. Ms. Darcy Bradbury, D.E. Shaw & Co.
I'm here.
Mr. Rosario Chiorenza, Morgan Stanley. Ms. Betsy Cochran, Barings. Mr. Dominic Falco, BNY Mellon. Ms. Vera Horgan, Wellington Management.
I'm here.
Ms. Tara Cruz, ISDA.
Present.
Ms. Alessandra Riccardi, National Futures Association. Ms. Sashio Sakimi, BlackRock.
Present.
Mr. Andrew Smith, Virtue Financial. Mr. Nick Steele, Barclays. Ms. Christine Stevenson, BP Energy. Mr. Chris Walsh, AcadiaSoft. And Ms. Wendy Yoon, Securities Industry and Financial Market Association Asset Management Group.
I'm here.
Okay, did I miss anyone? Okay. Thank you very much. And please email me in case you joined the call later. Thank you again.
Thanks, Warren. With that, I'd like to turn the program over to Angie Karna, the chair of the Gmac, for an introduction of our presenters.
Thank you, Andre. Just a few logistical reminders. Please keep your phones on mute while you are not speaking. Following the presentations, if a Gmac member or commissioner would like to be recognized to speak, please use the WebEx chat icon at the bottom of the screen. Then select the All Panelists option within the drop-down menu, indicate that you have a question, and press Enter. Please identify yourself and your firm prior to speaking and indicate when you are finished speaking. The first item on the agenda is a presentation from Siyash Paliwal, Director of the CFTC's Office of International Affairs. Mr. Paliwal will give a presentation on international coordination efforts in the time of COVID-19. Please go ahead, Mr. Paliwal.
Well, good morning, everyone. Thank you, Angie. Thank you, Commissioner Stump and Andre, for the kind invitation to speak at this Gmac meeting. Thanks also to Wendy for your leadership of the subcommittee, and I look forward to your presentation. It's my pleasure to share with you a few thoughts on some of the international coordination among regulators and supervisory authorities that has taken place as we have together faced the COVID-19 pandemic. It needs no retelling. This pandemic has roiled our daily lives and, as one dimension, roiled the markets in which we operate. Before getting into the substance of what I would like to share as to the attention, responsiveness, and cooperation among regulators and authorities in the global community, I would just like to say that I hope everyone on this call is doing well in this highly unusual and in many ways challenging environment. We all have our professional responsibilities and objectives, as well as our personal responsibilities to ourselves, our loved ones, children, elders, parents, in a setting where work-life balance has taken on new meaning. We've all made great efforts as we have weathered the recent weeks and maintained poise in facing the coming months. Here at the CFTC, we have been fully remote for about 2 months now and have been able to run all operations seamlessly and without interruption through the teleworking mode. And just as an aside, I'm guessing we all remember that viral video from some time ago with a BBC interview of a professor in South Korea where his 2 young children suddenly barge in and stroll confidently over to their dad's home office desk, followed by his frantic wife trying to get the kids off the international airways and preserve some decorum of her husband's interview. Yes, I've heard all of that on calls since March, from kids to pets, construction workers, delivery folk, birds chirping, wind howling, and all manner of life soundtracks. And for what it's worth, I have to say it has its charms. At the outset, I should note that any views I express do not necessarily represent the views of the CFTC or any commissioner, or purely my personal views, but hopefully you'll still listen. One of the hallmark features of this agency and its leadership, a value that I share, is transparency and stakeholder engagement. Indeed, the work of the Gmac and all the advisory committees exemplifies this. From the CFTC's Office of International Affairs, which is responsible for coordination of the agency's international and cross-border policy initiatives in bilateral and multilateral settings, we have a vantage point on the agency's manifold coordination efforts with our counterparts globally. So hopefully I can provide some useful insights to you and hear your valuable perspectives in the front lines of the derivatives markets. As perhaps many on this call have experienced, workloads in our space seem to have at least doubled, with some or all of business as usual taking place, and a whole additional layer of work relating to maintaining awareness of and responding to circumstances of the COVID-19 pandemic. It has been the same for regulators as we have remained vigilant to preserve the smooth functioning of our markets. In my remarks today, I would like to speak about 3 main things. First, I would like to provide some observations on how we have been thinking about the COVID-19 pandemic, how it has played out in derivatives markets, and manifestations we have focused on. Second, I'll give perspective on modes of coordination among regulators and authorities in the global community. And third, I'll share some thoughts on regulators' more pointed responses, both on an individual and multilateral basis. So first, to recap a few highlights of the COVID-19 turmoil. Coronavirus pandemic has led to one of the most volatile periods the derivatives markets has ever experienced. The volume of futures, options, and swaps trades had surged to an all-time high. But as we saw it, this was not a story of doom and gloom, but of resilience and robustness. Derivatives markets in particular served as shock absorbers rather than amplifiers of risk, internalizing the impact of the market swings. In many ways, it is a testament to the reforms implemented over the last decade following the 2008 global financial crisis. Prior to that crisis, derivatives markets were not heavily regulated. Following that crisis, regulators around the globe, through the G20, undertook to reform the derivatives regulatory framework with the basic ecosystem of trading and execution, clearing, and transaction reporting. That ecosystem, by and large, did what it was designed and built to do. In many ways, we could not have conjured up a better stress test. The virus knew no national or jurisdictional boundaries. Financial markets, participants, and regulators the world over faced the same sorts of challenges at the same time. Central clearing, as a concept, assures, among other things, that counterparty default risk is mitigated. And this is what happened. Rather than having volatility lead to widespread uncertainty or toxicity of assets or panic, the volatility was channeled as designed into the clearing ecosystem. The absorption mechanism, of course, was margin, and we saw that. Margin calls took place, margin levels increased substantially. This occurred with initial margin, where clearinghouses balanced risk management objectives and anti-procyclicality concerns, and significantly more so with variation margins. Generally, across the board, margin was provided as required, testament not only to the clearing ecosystem, but also to the resiliency of financial and non-financial cleared market participants. In addition, reforms put in place by the CFTC since 2008 required enhanced transparency and competition, both of which help ensure price discovery and improved pricing and liquidity for market participants, including producers and processors seeking to hedge their risks. For example, reforms of swap execution facilities required additional pre- and post-trade price transparency and competitive methods of execution. This helps ensure that swaps markets, which are critical to many types of financial instruments, from interest rates underlying mortgages to currency exchange rates, remain transparent, fair, and competitive. Moreover, recently proposed amendments to swap data reporting rules would, for the first time, require the reporting of margin and collateral data for uncleared swaps. If adopted, this proposal will significantly strengthen the CFTC's ability to monitor for systemic risk in uncleared swaps markets. Clearing ecosystem requires resources and expenditure to maintain. It proved its resilience in merit. Capital markets functioned to enable market participants to generate money needed to meet margin calls. There was appreciable need for funds to meet margin calls, prompting something of a dash for cash, particularly denominated, which created room for liquidity support. This support came with central banks providing interventions through their facilities. To sum up this high-level recap, one takeaway is that financial markets did what they were supposed to do, enabling us to weather the COVID-19 turmoil and prepare for the denouement in the coming months. Before turning to my second main topic, coordination among regulators globally, I'll just share a bit about how the CFTC had adapted to the circumstances of the COVID-19 turmoil. In short, there was a heightened degree of internal and external-facing coordination and communication. Internally, the agency's leadership held frequent coordination calls, almost daily as the pandemic evolved and continuing into the present, at times holding multiple intraday calls. This enabled the agency's leadership to pool information and insights gathered from the markets, our registrants, domestic and international counterpart regulators, and the agency's world-class staff, and to respond timely, thoughtfully, and decisively. The agency's teams connected frequently with regulated entities, other agencies, Capitol Hill, the media, and even academics to produce the most informed responses we could achieve. And this will continue as we proceed from the liquidity strains of the recent few weeks to the coming months as the economic consequences of COVID-19 continue to unfold. Of course, we were not alone in this sort of mode of response. The Office of International Affairs held periodic check-ins bilaterally with key counterparts in the UK, Europe, and Asia to maintain awareness of the ebb and flow of the virus itself and its market impacts. The responsiveness was consistent among our counterparts, from adapting to remote working, to relating institutional preparedness, to communications with market participants, to careful consideration of targeted responses. But turning now to international coordination more directly, in many ways, the multilateral bodies at the forefront of the regulatory response to the 2008 financial crisis, and in the case of the Financial Stability Board, established in the wake of that crisis as a successor to the Financial Stability Forum, served an important function in the COVID-19 turmoil. It provided an established mechanism of international cooperation already in place for information exchange and, where appropriate, response. Just as we at the CFTC were undertaking frequent coordination efforts, and I would note the Treasury Department was coordinating similarly among U.S. financial regulators, international bodies were holding frequent coordination calls, drawing upon the deep and varied insights of their members. The International Organization of Securities Commissions, or IOSCO, played an important role in information sharing among securities and derivatives markets authorities globally. Recognizing that continued functioning of financial markets supports the real economy's efforts in adapting to the impacts of COVID-19 through the ability to hedge risks and access funding, IOSCO noted that financial market regulators are focused on the operational and financial resilience of market infrastructures, the operational capability of market users, and the continued flow of information to markets, as well as appropriate regulatory flexibility. During the COVID-19 turmoil, and through to the present, the IOSCO board and the IOSCO regional committees have been hosting regular calls to share information and coordinate responses as necessary. Banking and financial market regulators also continue to cooperate in the international arena to promote adequate liquidity and funding options. Financial market regulators have shared, and IOSCO has collected, observations about responsive steps, market dynamics, and developments generally, and notably, the effects of authorities' responsive steps. IOSCO itself pivoted in its planned work for the year to adapt to the prominence and importance of monitoring and addressing the impacts of coronavirus. The Financial Stability Board, in whose work the CFTC has participated, similarly played an invaluable role in promoting frequent information sharing among its members, allowing central banks, finance ministries, and market regulators to share insights. This proved especially significant as central banks around the world were undertaking various support measures, sometimes unconventional, in response to challenges in financial markets. The FSB's COVID-19 work included regularly sharing information on evolving financial stability considerations and appropriate responsive policy measures through calls among members and compilation of members' responses, reviewing potential financial risks and vulnerabilities, and as appropriate, coordinating policy responses to promote global financial stability keep markets open and functioning, and preserve the financial system's capacity to finance growth. Moreover, there has been a strong bridge between IOSCO and the FSB, enabling robust collaboration between these two institutions. Through the IOSCO's Financial Stability Engagement Group, the CFTC and other financial market regulators in the Americas, UK, Europe, and Asia Pacific have integrated into works of the FSB and advanced IOSCO's work in furtherance of IOSCO's objective to address systemic risk, which coexists with the objectives of protecting investors and maintaining fair, efficient, and transparent markets. Indeed, as the FSB observed in its note on the COVID-19 pandemic, financial stability implications, and policy measures taken, COVID-19 related developments have resulted in a surge in volumes cleared in central counterparties, along with increased margin calls. The point of strength is that CCPs and their large clearing members have shown resilience during COVID-19 developments. The third and last theme I wanted to touch on is some of the actual responses that regulators considered appropriate to help financial market participants weather the COVID-19 turmoil. The CFTC published a series of no-action letters for targeted temporary relief aimed at easing the impact that COVID-19 was having on derivatives market participants. Social distancing has created novel hurdles to complying with regulatory requirements that were written with traditional centralized offices in mind. Some no-action letters aimed to facilitate physical separation of personnel in response to the pandemic, targeting swap dealers and members of designated contract markets and swap execution facilities. The no-action relief addresses the application of certain CFTC regulations where compliance is anticipated to be particularly challenging, sometimes impossible, because of the displacement of registrants' personnel from their normal business sites. A later no-action letter covers the net capital treatment of loans obtained by futures commission merchants and introducing brokers through the Paycheck Protection Program administered by the Small Business Administration under the CARES Act. In total, roughly a dozen no-action letters aim to assist market participants in dealing with the impacts of COVID-19. Turning to the international front, as previous speakers have noted, in early April, IOSCO and the Basel Committee on Banking Supervision agreed to a one-year extension of the deadlines for the last two implementation phases of margin requirements for uncleared swaps. There was notable sentiment that at a time when market participants were spread thin in their resources and using the resources they had to address the impact of coronavirus, these forthcoming deadlines were worthwhile candidates for extension. Agreement was achieved relatively rapidly, and it was equally understood that in order for this relief to be effective, it had to be adopted at an international level. Of course, margin requirements are a key reform, supporting the stability of derivatives markets and our financial system generally. In this case, with an extension that may affect a small percent of the total market, in a time when the market participants themselves are undergoing considerable amounts of strain, this change is worth considering. Again, it is my pleasure to have this opportunity to speak with you all, and I would be delighted to address a few questions and look forward to the remaining meeting. Thank you.
Thank you, Mr. Paliwal. The floor is now open for questions and comments on Mr. Paliwal's presentation. As a reminder, if anyone has any questions or comments, please indicate that on the chat feature of WebEx. Ms. Bellich?
Yes, thank you, Angie, and I hope everyone can hear me. I was having some audio connection earlier. Thank you again for this presentation, and thank you as well to Chairman Tarbert, Commissioner Stump, and Angie for leading today's meeting and putting forth two agenda items that are of critical importance for both regulated swap dealers and its clients. I'd just like to briefly say in support of some of the items that were just mentioned, it's very important for coordination between U.S. regulators and global regulators to continue, especially during times of stress and uncertainty, as is previously mentioned. It's meetings like the Gmac that allow these critically important conversations and dialogue to continue so that we can manage and assess new and existing risks associated with the global OTC derivatives markets and to look for opportunities to appropriately ease the burden for its market participants. So further support and strongly stress the additional items and areas of relief that the commissioners may be considering as we move forward through this pandemic. Thank you.
Thank you. Does anyone else have any questions or comments? All right, wonderful. Thank you very much, Mr. Paliwal, for your very comprehensive presentation.
Thank you.
Before our next presentation, I'd like to turn the agenda over to Andre for a roll call update.
Thanks, Angie. I just wanted to note there are a few Gmac members who are present on the phone, but for whatever reason were not able to respond during the roll call. Let me list them out really quickly. Edward Backer, Morgan Stanley; Ashley Bellich, RBC Capital Markets; Sunil Coutinho, CME Clearing; Paul Hamill, Citadel Securities; Adam Kanzler, IHS Markit; Jessica Soul, HC Technologies; and Masi Yamada, JP Morgan Securities. Thanks, Angie. Go ahead.
Thank you, Andre. The next item on the agenda is a presentation from the Gmac Subcommittee on Margin Requirements for Non-Cleared Swaps. The subcommittee will present its recommendations to improve scoping and implementation of initial margin requirements for non-cleared swaps. Many thanks to all of the members of the subcommittee, including the subcommittee chair, Wendy Yoon, for the great work on the report and recommendations. We are looking forward to your presentation. Ms. Yoon, please go ahead.
Thanks so much, Angie. Before we begin, please let me state that the views I express today are my own and not of my firm's. I am participating on behalf of the Margin Subcommittee as co-head of the SIFMA Asset Management Group's Derivatives Committee, whose member firms serve a wide array of buy-side end users, such as pension funds, institutional investors, corporates, endowments, U.S. mutual funds, UCITS, and private funds. Now, on behalf of the Margin Subcommittee, we would like to thank Chairman Tarbert, Commissioners Stump, Benham, Kintez, and Berkovitz, and members of the Commission staff and the Gmac Committee for having us here today. In particular, we'd like to extend a special thanks to Commissioner Stump for her continued focus on critical margin issues and their unique impact on the later phase market participants, such as American retail investors and retirement savers, and for her leadership in creating this Margin Subcommittee to offer recommendations to address those challenges. Additionally, we'd like to acknowledge and thank Warren Gorlick and Carmen Makanda-Terry for all of their time and invaluable contributions throughout the process of preparing the Margin Subcommittee's report. First, we'd like to commend the actions that the Commission has taken thus far, such as the codification of a new Phase 5 and thus extending the existing $8 billion ANA threshold out to a new Phase 6 when a majority of smaller end users are expected to come into scope. We're also pleased to hear Chairman Tarber's support of the CFTC's adoption of the one-year extensions recently recommended by BCBS IOSCO in relation to the COVID pandemic. However, as end users, asset managers, dealers, custodians, and vendors approach these later phases, we believe that there are still significant scoping and implementation challenges in bringing in such a large and diverse group of market participants into compliance with the CFTC's complex initial margin requirements for non-cleared swaps. Our report is intended to provide recommendations to address such issues in phases 5, 6, and beyond. Today, we ask the Gmac Committee to endorse these recommendations for action to be taken by the Commission. Our focus has been to make the CFTC margin rules more workable and efficient for entities subject to the remaining phases without compromising the overall goal of reducing systemic risk. According to the ISDA's initial margin phase-in analysis conducted in 2018, a significant portion of counterparties and relationships brought into scope in Phase 6 are not likely to be required to exchange regulatory initial margin, and those that do will make up a small percentage of the total industry ISDA SIM amounts. Therefore, we strongly believe that there is ample room to reduce the compliance burdens without affecting the regulatory objectives. As you can see from the executive overview in our report, starting on page 5 for those of you following in the document, we have bifurcated our recommendations into immediate term and later term asks. Immediate term recommendations are those encouraged to be actioned by the Commission prior to or as of the Phase 5 compliance date, whereas later term recommendations are ones urged to be adopted prior to or as of the Phase 6 compliance date. I'll now turn to the immediate term recommendations, the first of which is interpretive guidance regarding the application of the margin rules to separately managed account clients or SMA clients. Generally speaking, an SMA client such as a U.S. pension fund will invest in different investment strategies through multiple managers in order to diversify its investment perspectives, expertise, and asset allocations, and to mitigate concentration risks. Each manager typically has full investment discretion over its separate mandates for that client and has no transparency or control over the strategies or trading activities carried out by the client's other managers. The interpretive guidance is meant to confirm that covered swap entities, or CSEs, may document and split the $50 million regulatory IM threshold across different mandates for a single SMA client, so long as the covered swap entity and client allocate no more than $50 million in the aggregate. To the extent that the covered swap entity were to inadvertently exceed $50 million in uncollateralized IM exposure with that client, the covered swap entity could continue to trade with respect to that client mandate if, 1, it is being traded under regulatory compliant IM documentation, or 2, the covered swap entity and manager for the client mandate have agreed to a regulatory IM subthreshold, and that manager is trading at or below the agreed subthreshold. This is provided that the covered swap entity and managers of any other mandates for that same client are no longer continuing to trade, absent any other relief, and are working to reduce the aggregate uncollateralized IM exposures of that client back to or below $50 million. When an SMA client comes into scope under the margin rules, it is unlikely that all of the client's mandates will be papered under regulatory IM compliant documentation at the outset. And given the difficulties for covered swap entities in monitoring IM amounts on an intraday basis across multiple mandates and multiple trading desks at the covered swap entity and its affiliates, it is possible that the $50 million regulatory IM threshold could be inadvertently breached. Absent regulatory guidance on how covered swap entities should apply the IM threshold requirements to an SMA client's separate investment mandates, the covered swap entity may feel compelled to cease its trading activity with all of the client's managers, even those acting under regulatory IM compliant documents or within agreed allocations of the IM threshold. The halting of trading, in turn, could impair the investment activities and harm the underlying client. In order to help illustrate this issue, we have included as Appendix C the application of this interpretive guidance in various scenarios. Our next request is related to eligible collateral. Our recommendation is to eliminate undue restrictions on the collateral eligibility of money market funds, in particular the restrictions on money market funds to engage in repos, reverse repos, securities lending, and securities borrowing transactions. Under the margin rules, the Commission highlighted that these restrictions were to, quote, ensure consistency with a prohibition under the final rule against custodian rehypothecation of initial margin collateral, end of quote. However, under money market fund sweep arrangements, under no circumstances does the pledger's custodian have any right to rehypothecate, reuse, or take any other independent actions with respect to the pledged money market fund shares. Any transfer of the money market fund shares into or out of the segregated IM account are instructed by the pledgor and agreed to by the secured party. This is to ensure that the secured party always has a perfected first priority security interest in the pledged money market fund shares. Additionally, the trading activity of a money market fund is independently executed through its own fiduciary manager. Neither party to a swap nor their custodians have any say in the money market fund's underlying trading activities. Money market funds invest predominantly in treasuries and other high-quality short-term government securities. Most of them made available to the institutional market today use securities lending or repo arrangements to earn returns on cash and other high-quality assets, to avoid cash drag on performance, to diversify its investments, and mitigate its own exposure to its own custodians, insolvencies, or any consolidation issues it may have with its cash held at its custodian. market participants currently estimate that there are less than a handful of money market funds worldwide that would meet the collateral eligibility requirements under the margin rules. And globally, we are not aware of any single money market fund that would satisfy the CFTC's, the prudential regulators, and the EU margin rules. This severely limits the available use of money market funds as eligible collateral and introduces concentration risks, which in turn present a different set of systemic risk concerns. Our third ask focuses on the consolidation requirements under the margin rules. The Margin Subcommittee recommends that seeded funds be exempt from having to consolidate their ANA or material swap exposure amounts with their sponsors during a limited seeding period, provided that such sponsors do not guarantee the seeded fund's obligations. To clarify, a seeded fund is an investment fund, in particular U.S. mutual funds or insurance entities, that are typically seeded for a limited period with capital by a passive sponsor in order to establish a sufficient performance track record to draw on distributors and third-party investors. Such sponsors do not have any control over the trading or management of the seeded funds and typically provide no credit support or guarantees of the seeded fund's performance or obligations. Seeded funds typically would not exceed the ANA or material swap exposure thresholds absent the consolidation requirements with sponsors or other margin affiliates. As a result, the U.S. margin rules put U.S. seeded funds at a disadvantage when compared to non-U.S. seeded funds, such as UCITS funds that are not subject to the same consolidation requirements under other margin regimes. It also potentially puts U.S. covered swap entities at a disadvantage, as non-U.S. seeded funds may intentionally decide not to trade with them to avoid the U.S. consolidation requirements. This relief would be consistent with the treatment of seeded funds by the Federal Reserve and the Commission under the Volcker Rule. Our next recommendation is related to small covered swap entities. We ask that the Commission grant no action relief to small covered swap entities to allow them to rely on their covered swap entity counterparties for purposes of calculating regulatory initial margin. Many of the phases 5 and 6 small covered swap entities coming into compliance with the IM requirements have elected or intend to use the grid method for calculating regulatory IM, whereas the majority of the larger covered swap entities are using the IS-to-SIM model. Absent the recommended no action relief, this conflict could create potential barriers to phase 5 and 6 small covered swap entities from being able to engage in in-scope swap transactions. Our final immediate term recommendation is for at least phases 5 and 6 to grant a one-time up to 6 months grace period for compliance with the margin rules, starting from the date that the regulatory IM for a relationship has exceeded the 50 million IM threshold. While we acknowledge and appreciate the actions already taken by the Commission and urge their adoption of the one-year extensions of the phases 5 and 6 compliance dates recently recommended by the BCBS IOSCO revised margin framework in relation to the COVID-related pandemic, there are still significant challenges for market participants to complete the necessary documentation and operational setups on a timely basis without notwithstanding their best efforts to do so. For example, it's estimated that for the account opening process, document negotiations, and operational setup, it could take up to 12 to 18 months to complete, given the large swell of new market participants and trading relationships coming into scope in phases 5, 6, and beyond, and the extensive due diligence and background credit checks and operational checks that custodians will need to complete on clients with whom that they do not have prior relationships. Additionally, with the compressed time frame between the ANA measurement periods and the associated compliance dates, some financial end users may not know with any certainty if they're in scope or not until the end of the ANA calculation period, which is potentially just 3 months before the compliance date. This is especially true for SMA clients who need to source the notional exposure data from all of their asset managers and then calculate the aggregate ANA or material swap exposures not only under the U.S. margin rules, but potentially across all other relevant jurisdictions using different methodologies and calculation periods. This is especially challenging as some custodians have set deadlines well before the end of the ANA or material swap exposure measurement periods for the necessary documentation and operational setups to be complete. And just to be clear, the parties would be expected to begin exchanging initial margin as soon as they're ready to do so during the 6 months grace period, rather than delaying the exchange of IM until the end of that period. This was intended to strike the right balance between, on the one hand, providing a fail-safe for market participants facing hurdles despite their best efforts to comply, and on the other hand, ensuring the exchange of IM is not unduly deferred. Having gone through our immediate term recommendations, I'll now give a brief overview of our later term recommendations. The first of which is to permit each SMA client to be treated as permit each SMA client mandate to be treated as a distinct entity to which a separate regulatory IM threshold would apply. Or alternatively, subject to meeting certain conditions, allowing covered swap entities and managers of SMA clients the option, but not the obligation, to apply a flat IM threshold of $10 million per mandate. Just as covered swap entities and managers confronted challenges in 2017 in having to share the total $500,000 minimum transfer amount for a common SMA client, which, by the way, led to the CFTC No Action Letter 1712. The same issues exist with having to share and monitor against the aggregate $50 million IM threshold across the managers for a common client due to the same lack of transparency or control among those managers. Absent the recommended relief, each manager will be forced to make cost-benefit decisions as to whether to put in place regulatory IM documentation and custodial arrangements solely based on their siloed transactions. Moreover, to the extent that covered swap entities do not suballocate the IM threshold across the various managers for a common SMA client, some managers may be exposed to cliff edge scenarios where they have to immediately stop trading or terminate or novate existing transactions if the client's aggregate regulatory IM inadvertently exceeds $50 million. Such accidental breaches could result from operational constraints for covered swap entities in aggregating and monitoring the regulatory IM on a real-time basis across their consolidated affiliates, or based on receiving end-of-day allocations of bunched orders or block trades from managers. Our next request is in respect of the material swap exposure calculations and the post-phase-in compliance dates and periods. Here we recommend that the Commission align the timing and methodology for the material swap exposure calculations and the post-phase-in compliance periods with the BCBS IOSCO framework and other global regulations. Under the BCBS IOSCO framework and the rules of all other non-U.S. jurisdictions, the ANA amount is to be calculated during the months of March, April, May, and based on month-end averages, unlike the U.S., which is based on daily averages. Additionally, under the BCBS IOSCO framework, the post-phase-in compliance periods remain from September 1st through August 31st of the following calendar year, whereas the U.S., EU, and Switzerland moved to a January 1st to December 1st compliance period. These differences in the U.S. margin regulations create complexity and confusion and could lead to additional costs and compliance challenges for market participants who will likely be subject to margin requirements in multiple global jurisdictions based on their own domicile or principal place of business, as well as those of their counterparties. Next, in relation to the minimum transfer amount, the Margin Subcommittee asks the Commission to codify prior CFTC staff letters 1712 and 1925, which allowed cover swap entities and managers for SMA clients the option of applying the flat IM and VM MTA of $50,000 per each mandate, and the ability to split the maximum allowable MTA between initial margin and variation margin. As no action relief can be revoked or expire, codifying these changes would provide certainty to market participants as they negotiate collateral documentation and invest in operational builds. While 1712 is not time-bound, the relief granted under 1925 expires on December 31st, 2021. And finally, in relation to FX, we urge the Commission to continue to reassess the market impact, especially on small financial end users, of requiring deliverable FX forwards and swaps to be included in the material swap exposure calculations, and consider an amendment to the margin rules to exclude deliverable FX from such calculations. Although deliverable FX is not subject to the regulatory IM requirements, its inclusion in the material swap exposures calculations will cause a significant number of small financial end users to be scoped into the remaining phases. According to the CFTC's Office of the Chief Economist, 200 of the 700, or approximately 30% of the financial end users in what are now known as phases 5 and 6, will have material swap exposures due to deliverable FX. While many of these end users do not pose material systemic risks and are unlikely to exceed the 50 million regulatory IM thresholds, they still will be subject to the operational and compliance burdens of monitoring regulatory IM levels on an ongoing basis. Additionally, while some end users may trade a limited amount of in-scope products in addition to FX, they will likely be deprioritized by their cover swap entity counterparties in setting up the necessary documentation and custodial arrangements, which in turn could negatively impact their performance. Now, this concludes our list of recommendations outlined in the report. With that, please note that on April 23rd, 2020, the Subcommittee on Margin Requirements for Non-Cleared Swaps voted to adopt the recommendations to improve scoping and implementation of initial margin requirements for non-cleared swaps and referred the recommendations to the Gmac Committee for consideration. I thank you again today for your time. I'll stop here to open it up for any questions from the Commission or members from the Gmac Committee.
Thank you, Ms. Yoon, for the comprehensive presentation and your leadership. And thank you again to all subcommittee members for your time, effort, and thoughtful insights that went into your report. Before I open the discussion up, I'd like to turn the agenda over to Warren Gorelick for a subcommittee roll call update.
Thank you. I just want to note that the following additional people who are subcommittee members have indicated their presence on the call who were not present when we did the earlier roll call. And that is Mr. Rosario Chiarenza, Morgan Stanley, Ms. Betsy Cochran, Barings, Mr. Dominique Balco, BNY Mellon, Ms. Alessandra Riccardi, NFA, Mr. Andrew Smith, Virtue Financial, Mr. Nick Steele, Barclays, Ms. Christine Stevenson, BP Energy, and Mr. Chris Walsh, Acadia Soft. And with that, I will turn it over to Andre Goldsmith, who has an additional update.
Thanks, Warren. Just two additional Gmac members that I want to note their presence on the call. Jerry Corcoran, R.J. O'Brien and Associates, and Joe Nicosia, Louis Dreyfus Company. And now I'll turn it back to Angie. Thank you.
Thank you, Andre. At this time, I'd like to open the floor for discussion of some key questions that arise from the subcommittee's recommendations and the comments already provided today. To start off with, to the extent that the Commission implements the BCBS IOSCO recommended extension of phases 5 and 6 to 2021 and 2022 respectively, is there still a need for a grace or forbearance period as referenced in the subcommittee report? And if so, why?
Thank you for that question, Ms. Karna. I'll turn it over to my colleague, Betsy Cochran from Barings, to see if she would like to provide any initial thoughts. Oh, apologies. I misspoke. I meant Darcy Bradbury from D.E. Shaw.
Hi, it's Darcy. Can you hear me?
Yes, we can, Darcy. Thank you.
Great. It's kind of complicated, the whole chat function. So, yeah, it was interesting. The committee spent a lot of time thinking about this, and over the deliberations actually narrowed our recommendation. And we really focused on this sort of big crowd, small pipe problem. As Wendy noted in her summary, there's a pretty long lead time to in this period when there's so many hundreds, potentially thousands of entities who are going to try to get up and running. And so the custodians, and I don't mean to blame them, I think they're kind of the people who see the whole process, have suggested a time period of potentially 8 months or more to before the deadline if you want to get in. And the thing is, facts can change, and because of changing facts, someone might not be in the queue in time to actually make the deadline. So Wendy mentioned the ANA measurement period, particularly, I would say, for kind of less engaged entities who may be somewhat surprised or have a complicated process to figure out if they're actually in scope. But you could also have the situation where you get a new mandate. Should you not be able to do business with a new client for 6 or 12 or 18 months waiting to try to get in? You could have, you want to launch a new fund. If you wanted to launch a new fund starting in June before a September deadline, you would literally not be able to do that and might end up having to wait a full 9 or 12 months. You might have brokers that you currently just do a modest amount of business with that you want to do more business with. Maybe one of your other brokers has a financial instability. You know, we won't wish that on anyone, but, you know, things are changing rapidly. So you could have facts that actually change that mean that you weren't in the queue soon enough. And so we think for those situations, as long as the parties are working diligently to get into, they're in the queue, they're starting the process, they're working hard, but to make them halt all business for potentially a sustained period of time because they weren't in the queue, they didn't anticipate this problem 8 to 12 months before the deadline, seems unreasonable, particularly, you know, given the overall kind of risk that any one of these entities posed. So we do think that the idea that entities have to be working diligently to come into compliance, and as soon as they do, they have to start posting margin, so it's not like they get an automatic 6-month extension. So that was really our thinking about this. We are hopeful that after phase 6 and the sort of, you know, cleanup period after that, that this won't continue to be something that the market needs.
Thank you, Darcy. I'll also see if, is Dominic on from Boney? I think he was hoping to add some thoughts from a custodian's perspective as well.
Yes, Wendy, I'm on the line. Can you hear me?
Yes, thanks.
Okay, great. So yes, I think Darcy's points are all, you know, very important for us to consider. I think from the custodian's perspective, looking back at previous phases, a couple of things or a couple of facts came out of the earlier phases where, in fact, we were dealing with fewer counterparties that needed to comply with the regulations. In particular, the KYC process can be long and drawn out, especially with entities that may be in higher risk jurisdictions as determined by the respective custodians. Remember in this case that the collateral provider, collateral receiver, needs to sign up with a custodian of the collateral provider's choosing, which means in the case of the custodian, it is highly likely, and certainly we've seen this in previous phases, that entities that are brand new to the custodian will come in as a collateral receiver or secured party. That requires the custodian to perform KYC due diligence for that entity, and that can take a fair amount of time. In addition, because it is in fact the collateral provider that chooses the custodian to post, the collateral receiver will need to sign documentation with a variety of custodians outside of their own main operating custodian or custodians. So that means that the collateral receiver in these pairings, as we call them, may very well need to do KYC on a new custodian that's holding assets on their behalf that have been pledged to them by their collateral provider or counterparty in the transaction. So there's a fair amount of work on the KYC side from both parties, being the new participant under the regulations in phase 5 and phase 6, as well as the custodian. Also, I think we've added some flows in terms of the required custodial documentation, in addition to any account control agreements that are out there, where just as you deal, say, predominantly with maybe a U.S.-based custodian, once you start to deal with
collateral providers, your counterparties that may be using either Brussels-based or Luxembourg-based custodians to provide collateral, there's extra documentation that needs to go into the pack of documents that need to be agreed prior to the exchange of collateral. So it's the combination of the KYC process that could be required on both sides, plus the potentially exhaustive number of documents that need to be exchanged from both the provider side and the receiver side in each pairing, because remember, we do it on both sides. Those particular items really drag out the process for some entities to get up and running in order to exchange collateral. With that, if there's any other questions on it, I'd be happy to explain more.
Thanks, Dominic. It's Wendy Young again. I would say also for our own proprietary funds, it's easier to know in advance whether or not you think a fund might be close to or exceeding both the ANA thresholds as well as the Reg IM thresholds. However, with respect to SMA clients, you really don't have that level of transparency because you don't have any knowledge of the trading activity outside of your own mandates. And so when you do get that information from clients, you're kind of in a scramble to now quickly get the documentation in place. You have to have certain additional conversations with the clients about whether or not they want to use their own custodian or using a tri-party collateral agent. And we don't typically, as asset managers, have the authority to negotiate these types of arrangements for clients. So there might be also additional documentation and discussions about amending your authority under your investment management agreements or coming up with all the other necessary setups in order to engage in the tri-party arrangements on their behalf. And again, oftentimes you may not be told until very close to the end of the ANA calculation period if they plan to be in or not.
Thank you, Wendy and fellow subcommittee members. Any other thoughts on this before we switch topics?
Hi, this is Matthew Yamada from JP Morgan. I just wanted to make a quick comment, but before I do that, I did want to reiterate the thanks to Wendy and the other margin subcommittee members for all of their, clearly a lot of work went into the preparation for this meeting. And very frankly, it's extremely reassuring to see that in these unprecedented times, we are we're still able to advance the regulatory agenda in a very BAU-like fashion. So thank you again for all the hard work that you put into this. Just one counterpoint to the 6-month extension point. My only concern with it is it's clear that there's a lot of complexity and we may need more time. It's just that if the CFTC is the only one that grants this extension and other regulators and both nationally and internationally do not, we end up having to comply anyway. And it actually, in our experience, when these sort of situations occur, when we have split deadlines for the same item, it actually adds operational complexity in the rollout. And frankly, mistakes do happen and things get misclassified. So in many ways, we would definitely support the 6-month delay so long as it was coordinated with other agencies and we have that global and frankly cross-regulated consistency.
Thanks, Mr. Yamada. For the subcommittee, there's a great deal of focus in your report and in your comments on separately managed accounts. Can you just step back a minute and highlight what makes separately managed accounts different from other potential participants in the next 2 phases, like a large producer or a corporate end user?
Thanks, Ms. Karna. I'll turn that over to Betsy Cochran from Barings.
Hi, this is Betsy. Can you hear me?
You can.
Okay, good. Thank you. Thank you for that question. So separately managed accounts are typically utilized by large pension funds and other types of institutional investors investing on behalf of retail clients in order to provide diversity within portfolios for retail investors and for 401ks and retirement schemes. What makes SMAs unique is that it's a type of vehicle set up by investment managers to permit these types of large pension funds to get exposure to particular strategies at reduced fees oftentimes, and also without having to expose their investments to the liquidity risks of other investors, so that they can maintain the diversity within their portfolios in a more controlled way. And these are valuable instruments for these types of larger pension funds and also other types of retirement accounts where the investment managers are really looking to get diversity across a number of different managers in a way that is economically beneficial to the underlying investors.
Hi, it's Wendy Yan too. I would agree with everything that Betsy has highlighted. Also, I think as we are approaching phases 5 and 6, there are more separate accounts that are going to be brought into scope as a result of the drop of the ANA thresholds down to 50 billion and 8 billion. I believe even in the CFTC margin studies, there's discussions about how there are over 7,000 IM relationships that will be brought into scope. 200 in phase 5, 200 new entities in phase 5, and 500 entities that would be captured in phase 6. I think the concern or the difference between corporate end users or large producers is that in many cases, those type of entities either trade for themselves or may operate through a single or a limited use of asset managers, whereas SMAs or institutional investors, pension funds, and others for diversification reasons and otherwise may hire multiple asset managers. And so having to comply with some of the requirements under the margin rules, such as having a consolidated IM threshold, a consolidated ANA threshold calculation, those require a lot of coordination and a lot of aggregation by those clients of the different trading activities of their different managers. They themselves don't have that information at hand, and they're not usually involved in the actual trading itself. So, for them, they have to collect the information, aggregate it, and then distribute it back out to their swap counterparties as well as their asset managers. And it's those types of requirements where you're measuring on an aggregate basis under the margin rules that make it that much more difficult for the separately managed account clients to comply with.
Angie, I have a question regarding the separately managed accounts.
Yes, please go ahead, Ms. Burnett.
I actually have, a few sub-questions. The two options that that was suggested, one was to consider each SMA client as a distinct, regulatory client, and the second option was to have a flat 10 million threshold, which was not an obligation. It's an option, but an obligation. In that second scenario, by giving 10 million flat, how do we differentiate, the creditworthiness or the amount of trading that might be done, with one, asset manager, relative to another? Because in many cases, you may be using, swaps as a hedging instrument, and rely on the expertise, of one or two asset managers, and not all the asset managers that you may have a SMA account for. Then the other thing is, I think, from a, asset management perspective, and, trading in general, it is important that you have certainty, of what is to be expected, and there is continuity of your ability to hedge. So concern that I would have in that in the second option is that as Wendy mentioned, that there could be scenarios where there's a cliff edge issue where you for a period of time may not be able to trade because another SMA entity might have exceeded the threshold limit, which would stop all entities or all asset managers to trade. So how would we manage that? And also who in these scenarios, who would be the accountable party to make sure that there is aggregation of the $50 million happening on a timely basis, and more importantly, also to be making sure that the various asset managers are aware of that in order to avoid a sudden threshold, a sudden $50 million threshold without having documentation in place. I know I have a few questions in there.
No, thank you for that. Maybe if we can I'll try to attempt to unpack and answer some of those questions and defer to some of my colleagues to also chime in. In terms of the request for the either treating each mandate as having its own regulatory IM threshold or the application of a flat 10 million IM threshold per each mandate relationship with a dealer. That came out of the concerns that you highlighted there in terms of the fact that it is very difficult and challenging for the covered swap entity and the managers to be able to monitor the aggregate 50 million and to do so on a dynamic basis. Many covered swap entities don't have a single trading entity that trade derivatives or in-scope products, but instead may have many different desks across different divisions that are trading with managers for that same common client, and to be able to aggregate those numbers on a real-time basis throughout the day to make sure that they don't have any kind of inadvertent breach is very difficult. It also could come, as I mentioned earlier, where in many of the asset managers' trading activities, we trade in large block trades throughout the day and then only allocate to the individual accounts at end of day. So dealers may be getting that information on an end of day basis and then realizing that some of these trades are being allocated to accounts that are already kind of in the danger zone. So the idea of the flat IM threshold of 10 million was really to try to address that, to say, similar to the MTA, that dealers would have the ability but not the obligation to agree with managers for a separately managed account client to using a flat IM threshold for each one of the those relationships, and therefore each manager would have the transparency and control of their 10 million sleeve and know when they're getting closer to the danger zone, so they could also be monitoring when the client's getting close to that number or that threshold, as opposed to just
in that particular case, wouldn't it be better to not give the option? I think that the dealers should be required to give that information to the manager, because I think that's where there's an introduction of not knowing, or the certainty starts to become a little gray on the asset management side.
Yeah, I think in a perfect world it would be great to have a flat IM threshold or giving some level of certainty for each manager for that particular client as to what his Reg IM threshold would be. I guess the concern about making it mandatory for dealers to have to actually provide the flat 10 million IM threshold for each account is that it doesn't offer the flexibility, and in some circumstances it may warrant not using that flat IM threshold. So for example, you could have a situation where a client doesn't trade a lot of derivatives or in-scope products except for through one single manager out of the bunch. Excuse me. So it could be more efficient for that dealer to agree to allocating a larger sub-allocation of the 50 million to a single manager and not allocating to others or allocating less to the other managers, therefore keeping everyone below 50 million. So there could be other scenarios where it could warrant something different from having the flat IM of 10 million. Otherwise,
so you're saying that I might have misunderstood then, because what you're saying is that you will have certainty of what you're allocated. It just may not be 10 million. It could be 5 million. It could be 15 million, depending on the interpretation of how much business that asset manager would be doing on behalf of that end user.
Under the flat IM threshold of 10 million, you definitely have that certainty. If the dealers and managers do not agree to using the flat IM option, then you would only have certainty if that particular dealer does agree contractually with either all or a subset of the managers as to what their allocation of the IM amount could be. In some cases, they could decide to take different approaches with different managers for that same client. It could be for 5 different managers for the same client. They could choose to allocate and document with one and only allocate a sub-IM threshold to another, and for the rest of the managers not provide any allocation or any transparency as to how much they can trade up to, and that they would just monitor accordingly to ensure that the account and the aggregate doesn't exceed 50 million. I'll ask the Sachio from BlackRock. Would you like to add anything on that?
Yeah, thank you. It's Sachio. So I would say that the flat IA proposal, because of the flexibility, one of the challenges from the asset management side is that we do not know if we'll have the 10 million, but it does allow the dealer to right-size the allocation depending on the strategy of the manager. So there are pros and cons to the flexibility of it. One thing that should be highlighted is that if we were to get the flat IA proposal sanctioned by the Commission, in order for each manager to maintain its separateness in the event that a particular manager happens to breach its threshold, we would still need interpretation or sanctioning from the Commission that the Commission views each separately managed account relationship as separate, so that in the event that a particular manager breaches its subthreshold, it does not impact the activity of the other managers, so as to avoid any cliff edge events that Wendy mentioned, and that there is continuity in trading for the client.
Thank you, Sachio.
Thank you, Wendy and Suparna and others for your feedback. Just thinking about this flat IM threshold a little bit more, I'm curious about whether there was discussion about, for SMA clients, whether a flat IM threshold of 10 million per separately managed account could result in an aggregate uncollateralized regulatory IM going beyond 50 million. In other words, what would mitigate against clients or managers intentionally setting up additional SMAs for the same legal entity to avoid being subject to a $50 million cap?
Thank you, Ms. Karna. I'll turn that over to Betsy.
Yeah, sure. That is, obviously that is a risk. I don't think that any manager would deliberately do that to evade these regulations, and if they were to do that, the anti-evasionary powers that the Commission has and that various regulators have could be brought into bear. What I think is important, particularly with the flat IMA, is that it gives these types of investors, institutional investors, pensions, and that nature, the ability to achieve diversification throughout their portfolio without having to worry about narrowing their options in order to maintain just 5. Saying that we adopted the 10 million just 5 investment managers, where their clients might be better served by having, 6 or 7. Although I think most SMAs, most SMA clients typically have somewhere in that ballpark. But, they could potentially have more and they could potentially have less. So it is a risk. But the uncollateralized risk is also ring-fenced, although I know that doesn't give tremendous comfort across that particular entity. But it is a situation where the risk associated with that account and those trading strategies is ring-fenced for purposes of recourse. But then we do have exposure to other managers in their trading strategies, because if they were to breach, if we weren't to have this flat IM and they were to breach their particular allocation, as both Sachio and Wendy rightly pointed out, it would result in a particular manager not being able to engage in appropriate hedging activities based on the actions of others. And as a fiduciary, that's a very untenable position to be in.
And it's Wendy, and I would agree with everything Betsy highlighted. I also would add that there are some other natural guardrails that exist. So while theoretically you could have a situation where the aggregate does exceed $50 million, if you had separate managers and you allocate a flat IM of $10 million per each. I think one is the costs and burdens of ongoing keeping a separately managed account going is at what would far outweigh this benefit. You not only have to engage in a new separate investment management agreement negotiation with the manager and pay management fees for that particular account and the trading of that account, as well as the documentation of trading agreements and all of the other activities, and the client would have to allocate separate assets under management, or AUM, to that particular account on a go-forward basis in order to continue trading in that separate managed account. You also potentially have requirements for the account to have to register, based on its commodity activities as a CPO or CTA, as well as potentially having audited financials and other maintenance to keep it going as a separately managed account. You also have, I believe, the credit analysis and determinations by the dealer counterparties. They've, before even the margin rules have come out, they have also been focused on, making sure to minimize systemic risk, especially, following the 2008 crisis. So they will already require voluntary initial margin from some clients based upon the types of trades they're doing, based on the volatility or the leverage or the composition of that particular strategy. So all of that said, again, it's not obligated for the dealers to agree to the flat IM, and we believe that there are already natural guardrails that would prevent the client in the aggregate exceeding $50 million.
Great, thank you. Go ahead, Betsy.
I'm so sorry. I just wanted to add one thing to what Wendy pointed out too, in terms of the other guardrails that are available, is that these clients will obviously be posting variation margin on a daily basis, so their mark-to-market exposure will be covered. So it's there is substantial risk mitigation in that type of margin being provided.
Thank you. And just to go back to a point that Ms. Bedbrot raised, under this proposal, who actually is responsible for compliance? Is it the covered swap entity? Is it the client? Is it the asset manager? Who's doing the monitoring?
Sorry, go ahead.
Oh, go ahead, Wendy. I'm sorry.
No, please go ahead.
I think it would either have to be the covered swap entity or the client, but I think in this circumstance it's more appropriate to have it be the covered swap entity, since they're the entity over which their commission is exerting its jurisdiction, and particularly because they're the only ones who have the level, they and the clients have the level of transparency, but I think the CSEs have the level of transparency in a real-time basis that would permit them to monitor this.
And this is Wendy. I would agree with Betsy. I think that, one, under the regulation itself, the covered swap entity has a regulatory obligation to do the monitoring. If the managers had the flat IM threshold of $10 million or were allocated contractually some portion of the $50 million, then they would have the transparency and ability to control their own trading activity up to that threshold amount. So they could help with the covered swap entity in monitoring that they, in relation to their mandates, don't exceed that threshold. It's a lot more difficult for the clients themselves because, again, based on daily trading activities and changes in mark-to-market and market volatility, to have them, consume the data from all of the different managers on a daily basis, and then also be able to monitor and provide information back to the managers is very untenable, especially on a real-time basis or dynamic basis. So again, I think it's more likely to fall on the shoulders of the covered swap entity, and to the extent that the managers have transparency on them as well.
Thank you. Mr. Yamada, since this proposal will potentially fall on your shoulders as a covered swap entity, perhaps you could provide some feedback.
I'm happy to. So frankly, this the complexities of the problem have been very explicitly and well documented in this report. In particular, the Appendix C illustration very graphically and clearly illustrates the sorts of issues that arise from these information barriers. And frankly, it's our view that this is a very elegant solution to resolve that in a way that balances both the overall goals of limiting the buildup of unmargined risk, which is the regulatory goal, but also doing something that frankly acknowledges the practical realities of the structure of the market here. So both the intermediate solution, the proposed in Section 1, which would kind of require subdivision and then kind of I guess somewhat compartmentalize it. This actually is a better solution long term if it's able to be done broadly and embraced broadly, as it makes it much more easy to implement on a client by client basis. The flip side is if there's concerns about abuse and buildup and people setting up 10 accounts to try and do evasion, I think personally, given the friction associated with setup of so many accounts, those cases will be few and far between. And frankly, if the CFTC will clearly be monitoring this behavior, and if we see evasion or abuse, it can always be revisited and tweaked. But this really does feel like a very strong, a good compromise that I think the dealer community can easily embrace.
Thank you for that feedback. I would also add that I think dealers would not have the appetite of setting up and facing 10 separate, mandates with the same manager if there was not a separate trading strategies or reasons for it. And also for the client, it actually doesn't benefit them too, because each mandate would be margined separately, and so you will lose the portfolio margining benefits of having to post margin on a gross basis in relation to each account, separate from one another.
Yeah, it's our view. That's right. Those frictions are very significant, and the practical reality is we don't think this is a real issue. It's kind of an imaginary issue. If we do see it, obviously we can always clamp down on it, but it feels like a very reasonable compromise.
Would this solution provide the certainty to the manager based on whatever their allocated amount is, whether it's a flat 10 million or otherwise?
Yes, it would.
Great. Thank you all for your very helpful insights on what is a complex problem. I want to shift us to another one of the report's recommendation relating to small covered swap entities. In particular, how are smaller covered swap entities disadvantaged by the requirement to use a quantitative initial margin model like the ISDA-SIM if they don't elect the grid regulatory schedule? And under the subcommittee's proposal, which relates to relying on the calculation of their counterparty, would smaller swap dealers have any ability to reconcile or dispute margin calls if they were relying on their counterparty's SIM calculations?
Thank you for that question. I'll turn it over to Christine Stevenson from BP.
Great. Thank you very much. Can you hear me?
We can.
Okay, great. The smaller swap dealers may be disadvantaged overall by being restricted from participating in certain swap transactions. Commercially, being unable to agree on the model to be used in an IMCSA may impact the number of counterparty pairings among swap dealers, which not only potentially impacts liquidity in the swaps market, depending on the size of those various markets, by consolidating trades to perhaps some of the only larger swap dealers. It also limits the opportunity of the smaller swap dealers to compete in that space. And I think even if agreed between those who choose SIM may not choose to transact with the grid swap dealers in those cases, because oftentimes the grid method drives a higher calculation than the SIM model would, thereby causing some of those SIM swap counterparties to elect to pair with a non-grid participant. For some phase 5 and 6 participants, the choice to use grid is a reflection of the diverse nature of their dealing activity and, of course, the cost-benefit analysis of implementation. This takes into account their swap portfolio and the nature of their swap counterparties. The upfront requirements of model construction and approval, which it's probably appropriate to note at this point, other jurisdictions, including the EU, do not require the approval for these types of models, but we do, and the upfront requirements to do that are very resource intensive and, of course, must be weighed against the utility for those swap dealers with portfolios consisting potentially primarily of end users. You have examples in some spaces where perhaps 90% of the swap dealer's portfolio is end user. And with the 10% of dealers or financial end users with which they may have to post or collect IM, potentially they only meet the threshold, the $50 million threshold in a handful of cases. And so it is, it's a choice, a business choice that has to be made. And therefore, because of the flexibility to enable them to rely on the SIM counterparties calculation, would enable them in those circumstances to participate in the market and not be disadvantaged by choosing a model that, or making an election, I should say, that suits the vast majority of their business activity. With regard to reconciling, that is a challenge. We do note that that is a challenge. I think one of the options is that the smaller swap dealer using the reconciliation process by which they ensure completeness of their data set and transactions, in-scope transactions and material economic terms can provide that, along with indicators that can be developed using various VAR models, which would give them directional indications, could be used as a close proxy to determine, to reconcile those calculations. Potentially, some swap dealers, while the model might not be approved, they have other models that they've used prior to the rule coming into play, which they could use to gauge the reconciliation process.
Thank you. Any other questions or feedback on this recommendation? Okay, switching to, you've made a recommendation relating to seeded funds. So if the Commission were to exempt seeded funds from consolidating their ANA thresholds with their sponsors, is there any concern that market participants might trade through seeded funds to avoid aggregating their ANA thresholds?
Thank you. I'll turn that over to Betsy.
Hi, yes, thank you. I think much like the SMAs, the likelihood of that happening is very low given the expense of setting up a seeded fund and maintaining it and establishing all of that documentation, even if one market participant were to be acting nefariously. That really, I think, is very highly unlikely to happen because these types of funds are set up to allow U.S. fund sponsors to develop new products and to establish track records in order to be able to market and distribute those products to the market. And so these seeded funds serve a very important function within the investment management community to be able to innovate and develop new markets and react to what's going on in the world.
Thanks.
And there are also, I'm so sorry, I just wanted to add that there are also a number of regulatory and contractual and fiduciary constraints that would make the likelihood of that happening extremely, extremely low.
Great, thank you very much. As a general matter, would the recommendations being proposed in the report also need to be adopted by the U.S. prudential regulators, and in some cases, regulators in the EU, to have the desired effect? What would be the market or other implications if the Commission were to adopt the recommendations in this report, but the U.S. prudential regulators or regulators in the EU did not undertake consistent actions? Would there be concerns of a lack of domestic and, frankly, international harmonization?
Thank you, Ms. Connor, for that question. It's something that was largely debated by this subcommittee. I'll turn it over to my colleague, Tara Cruz from ISDA, to respond.
Thank you, Wendy. The answer here really varies depending on the recommendation. In the case of codifying the MTA relief, for instance, it would be beneficial for the CFTC to act alone since it's already done so by issuing that relief, although we would certainly welcome conforming amendments by the USPRs. For other recommendations, the U.S. is the global outlier, and therefore it can act alone, but it would be very useful if at least the CFTC and USPRs are aligned. That applies to recommendations regarding the timing methodology for material swap exposure calculations, money market funds, seeded funds, and the small swap dealer model requirements. Guidance or forbearance on separately managed accounts would also be useful from the U.S. regardless of whether it might be echoed from other jurisdictions. For other changes global alignment would be important, such as the post-phase-in compliance periods, for which it's preferable that both the U.S. and EU align with the BCBS-IOSCO standard. Thank you, Wendy.
Thank you, Tara. Commissioner Stump?
Thank you, Angie. I think this is the appropriate time, given that we are talking about the international application of some of these rules, and in some cases the divergence from international standards. But in the context of seeded investment funds, I was hoping that someone might address the manner in which the standards, the BCBS-IOSCO standards, apply in this context.
Sure, I'm happy to take that. This is Betsy Cochran. So BCBS-IOSCO has exempted all investment funds from having to be consolidated with their sponsors absent recourse against the sponsors. So if the sponsor or investment manager guarantees that particular fund, they are still going to be consolidated. But absent that, all investment funds, regardless of where they are in their seeding cycle, would be exempt. And our recommendation is not as broad as that. And that recommendation from BCBS-IOSCO has been adopted by most of the major global jurisdictions that we typically think about in this context, such as the EU, Japan, Canada, Australia, etc. And we just essentially took the language from BCBS IOSCO and added on a simple phrase saying for a 3-year period following the commencement of trading by that investment vehicle to capture what is the sort of standard seeding period for investment funds in the industry, which is about 3 years. So our recommendation is narrower than what our global counterparts have actually adopted, recognizing that there may not be appetite within the Commission or other regulators to grant that broad, the breadth of what our global counterparts have done, but both the CFTC and the prudential regulators have granted this type of relief for seeded funds, as Wendy pointed out, in the Volcker, under their adopting releases for the Volcker rule, where they recognize that for a period of 3 years, the prudential regulators and the Commission both recognize that for a period of 3 years, the Volcker rule requirements wouldn't apply to a seeded fund. And also in the material swap participant testing adopting release, the CFTC also recognized that investment funds and subsidiaries should not be considered when calculating a particular entity's MSP exposure. So that is where our recommendation came from, was directly from the BCBS IOSCO recommendation, but we narrowed it to that 3-year seeding period.
It's Wendy. And I'd also add that, and under some of the other jurisdictions, such as the EU, EU-regulated funds are not subject to such consolidation requirements when they are seeded as well. Many people have decided for prior phases to actually limit the counterparties with whom those EU-regulated funds would face to only other EU or non-U.S. dealers, so that they could take advantage of that deconsolidation for the fear of facing U.S. dealers and then being subject to the rules. So you might see liquidity shift if there is still that disparity between the U.S. and European or other jurisdictional rules related to seeded funds.
Thank you.
Hey, Wendy, this is Darcy Bradbury. I think the question was in part a little broader, which is about activity from other regulators, and certainly there are a number of these recommendations that we would encourage the U.S. regulators more broadly to consider, and we're hopeful that the CFTC would act in their leadership capacity to begin this debate and discussion among the regulatory community who have worked through so many of these issues on a harmonized basis. In some cases, as Wendy's noted one, our suggestion would actually bring the U.S., if it were adopted by all the U.S. regulators, would bring us into harmonization with the rest of the world. So the eligible collateral point, for example, is one where Europe and their regulations already have this included, and it was the U.S. regulators who deviated from the kind of global consensus in terms of constraining the types of money market funds that could be used. In each case, both jurisdictions want you to use local brands. So Europe wants you to use UCITS money market funds, and the U.S. wants you to use U.S. money market funds. But the U.S. Went away from the global consensus in terms of the particular constraints on the type of fund. So that would be an example where the move would actually be bringing the U.S. closer to the global consensus.
Great, thank you all. Ms. Belich, did you have some thoughts on this question?
Yes. Thank you, Angie. So bringing it back to your original question on coordination between the CFTC and the U.S. prudential regulators as well as the global regulators, it just kind of bears noting as well that as a non-U.S. bank, firms like Royal Bank of Canada are in that unique position of navigating multiple sets of rules at the same time. So, for example, the oversight and regulatory requirements of prudential regulators in our home jurisdictions, including those for uncleared margin requirements, swap dealer regulations promulgated by the Commission, and U.S. prudential regulations for uncleared margin requirements, as we have a wholly owned subsidiary bank here in the U.S., as well as any other jurisdictional requirements that may be applicable to a firm's client and or the trading relationship. So it bears noting again that this type of coordination is critically important, and having that clarity and consistency between U.S. regulators and global regulators is vital for non-U.S. firms like ours to continue business and expand business in the U.S., as well as, more importantly, to ensure compliance with U.S. regulations. I'd like to bring it back to as well one of the comments that was made at the top of the meeting around operational risk considerations. Again, from a large dealer perspective, this is critically important as we think about some of the recommendations contained in Gmac Subcommittee's report. Absent agency action, a number of these items, the complex and overly burdensome regulatory and operational issues will create obstacles for large dealers as well as their clients, increasing costs and decreasing liquidity. Again, as was mentioned, a number of the regulatory obligations actually sit with the dealer for these items. And so bringing that back again to a forbearance period or 6-month grace period is critically important from a dealer perspective, given that we do carry much of the regulatory obligation and burden around these areas and these recommendations contained in the report.
Thank you, Ms. Belich. I'd like to open it up for any further questions or comments on the subcommittee's recommendations. I'll remind you, you have a chat feature at the bottom of WebEx, so if you'd like to speak up, please let me know. And I'll also apologize if I missed any questions earlier on. I must tell you, between two screens, a paper script, a mute button on my phone, I think I may have missed one or two, so now is a great time to speak up again.
It's Wendy Young again. I would like to echo the thoughts that were just expressed about the dealer's obligations and the operational risks. I think that also does, though, also translate to additional challenges for asset managers in having to comply with rules, especially since we face a lot of dealers who are now dual-hatted, whether it be because they may be European domiciled but also registered as covered swap entities with the CFTC. You may have now a delineation or bifurcation of different rules that they may apply in trading with different types of clients. One of the concerns that we have is, as we trade in block trades and we don't delineate or don't bifurcate our client base, but we trade them in blocks based on common trading strategies, we could be trading for U.S. and non-U.S. accounts at the same time with any dealer counterparty. One concern is if dealers don't have the ability to apply consistency across the rule sets that apply to those trading relationships, you could see situations whereby they would apply the EU rules, for example, in relation to trading with European clients, and the U.S. rules in applying and in trading with U.S. persons. That would then cause potential fragmentation of block trades, to have to price them differently, trade them separately, margin them differently, especially if there are still these discrepancies or inconsistencies across some of the regulations of different jurisdictions, especially in terms of the types of eligible collateral, the timing, the methodology used in determining the ANA calculations or material swap exposures. So that does also present, risks to the end users as well as asset managers acting on their behalf.
Thank you, Wendy. Ms. Vedbrad?
Yes, I have a question on, collateral. Given that there is going to be an increase in the need for high quality collateral, at the back of this rule, but, also in general. Is there any concern that we may have a shortage of high quality collateral, and, would the money market funds be able to, help alleviate some of that pressure if they were eligible to post as collateral?
Thanks for that question. Darcy, did you want to take a stab at that, or I'm happy to?
Sure. I guess money market funds are pretty widely used for this service now. I don't have the numbers in front of me. Tara is kind of the expert on these, but billions of dollars are already pledged through these collateral arrangements for uncleared swaps that are not mandated by regulation. And the most common thing people do when you're an asset manager in that quote unquote voluntary IM situation is money market funds. And it's exceptionally valuable as a tool to use. The report details some of the benefits in terms of reduced counterparty risk and ease. And it's a widely used tool now. So we were, you can imagine our kind of surprise and disappointment when we learned that there really weren't very many funds that currently fit under the new rules. One custodial bank at a conference I was at, back when one could go to conferences, I said they had done a comprehensive review of the documents of hundreds of the high quality money market funds that are eligible, and they could find only, I think the number was 3 at the time, that would qualify under these new, much more restrictive rules. And I also just think when you think about all of the recent dislocations in the repo markets and the treasury markets, having access to a broader set of money market funds that are have a long track record and that we can feel comfortable with, we can do due diligence on, will make us more comfortable. So I'm not sure I addressed all the aspects of your question, but it is a very established practice now. There's a wide array of funds that asset managers can research and choose from if these eligibility rules were expanded to match the European rules. And we think it would be a valuable tool. Some people may continue to want to post Treasury securities directly if they have them, or other forms of cash, but I think this would be widely adopted if it was available.
Yeah, no, you did address it. My question was actually at the back of, in the presentation. I heard that most of the money market funds would not be eligible as collateral under the current rules. So, it was more like we actually should, propose changes so that the money market funds could be used, because they are used today. And given the increase in collateral, I think we should consider them to be essential as eligible collateral in this space.
It's Dominic Falco here from BMO Mellon, and I completely agree with what Darcy has said. I think, from our experience in the non-regulated IA market, substantially, money market funds account for, much of the collateral that's being segregated today. I would also add that in terms of the Phase 5 clients that are readying themselves for next year, there is a substantial request for the use of money market funds as they look at not only other forms of collateral, but potentially simpler forms of collateral to mobilize. Many look at cash collateral in their bilateral world today, and so it's a simpler process to simply move from cash to money funds and then post that into the requirements for the regulated collateral. So I would say that yes, it would go a long way to to filling any shortfall of available collateral that's out there. And it's also a form of collateral that many clients in the Phase 5 timeframe are looking to employ as soon as possible.
This is Wendy, and I would echo everything that has been raised thus far. I think that, as many of you know, variation margin, most of the buy-side community, I think it's over 75%, are still using cash as eligible margin for variation margin. In relation to voluntary initial margin, before the margin rules were ever promulgated in any jurisdiction, many people who were posting voluntary initial margin and setting up voluntary IM segregation arrangements were taking advantage of the money market fund sweep arrangements so that they could still continue to use cash and to meet margin deadlines on a timely basis, especially as those deadlines continue to contract under regulations. That afforded us the ability to use collateral management operations personnel to transfer the cash on a timely basis, avoid any kind of settlement issues, avoid any odd lot sizes, and avoid having to use traders to go and buy and sell treasuries and other types of other forms of non-cash collateral to meet the IM requirements. Here, that's what the current practice has been for voluntary initial margin. If we were to severely limit the eligibility of money market funds in relation to regulatory initial margin, now you have a bifurcation between what was posted for voluntary initial margin versus what's required for mandatory initial margin. You could see that causing some friction, and also, again, the idea of managers and end users having to now go out and buy the other forms of non-cash collateral to hold them, even though they may not be part of the investment strategy of the particular fund or client. It could also, result in any kind of tracking errors with benchmark strategies. It could, result in drag in performance and other errors. So we would think that the ability to use money market funds, continue to post cash, and have it swept into money market funds that we have agreed to with the secured parties or the dealer counterparties would provide us with the most efficiency and ability to diversify the types of eligible collateral that we can select from.
Thank you very much. Does anyone else have any further questions or comments on the subcommittee's recommendations?
Angie, this is Commissioner Stump again. I had a question. It's probably more technical than substantive, but with regard to the material swap exposure calculations and the calculation, the period of calculation and the method of calculation, as I understand it, the U.S. and Europe have taken a different approach from that that's outlined in BCDS IOSCO framework. In order to correct this situation, it is possible that we would all be going at different times in seeking to make this better. In doing so, practically, I'm curious what sorts of things we can anticipate. The report speaks to, entities not being able to take advantage of substituted compliance, for example. And I was just wondering if someone could lay out, this seems like a fairly difficult thing to effectuate given the number of different regulators that would need to respond. So I want to make certain that if this is submitted as a recommendation and the Commission takes it up, that we fully appreciate that the report has given, I think, a number of different manners in which we could handle this depending upon the activity of our other fellow regulators. So I was hoping someone could just speak more generally to the practical challenges such as substituted compliance, operational challenges. One of the things mentioned in the report that seems quite alarming to me is that this could result in disputes with regard to IM amount. And we certainly want to consider all of that given that the markets are global. So I was just hoping someone could elaborate a bit more on some of those more practical challenges with regard to these different calculation periods and methods.
Commissioner Stump, it's Tara Cruz. I'm happy to speak to that. So to be clear, there's sort of two aspects here. One is the material swap exposure calculation, for which the U.S. is the outlier globally. The EU doesn't align with the U.S. on this front in terms of the timing and methodology, right? So the U.S., once we move forward to phase 6, uses the June to August time period for that calculation, also requires a daily averaging, whereas BCBSI OSCO and all other major jurisdictions use the March to May period and use a month-end averaging. So for this calculation, what it means is that on a forever going forward basis, market participants who are, near towards the bottom threshold of 8 billion, and there's many of them, right, will have to, every year, to the extent they're caught by more than one regulation, have to run multiple separate calculations at different time periods and using different methodologies, and do separate notifications to their dealer counterparties regarding any change to their status, whether that be that they come into scope or they fall out of scope. And then the other aspect that makes it complicated is the bifurcation around post-phase-in compliance states. So under the BCBSI OSCO framework, once we get past phase 6, every year the reassessment regarding a party's ANA calculation, or MSC in the U.S., happens would become effective each September. So any changes would happen each September. So you keep the cycle that we've been doing now from September 1st to August 31st. But the U.S. and the EU and Switzerland shift after the phase-in period to a calendar year compliance cycle. Other jurisdictions do not. So when it comes to the application of a change to somebody's status, you could have that change apply at different times in different jurisdictions, which means the subset of transactions subject to regulatory margin in one jurisdiction might be different from the subset of transactions eligible subject to regulatory IM in another jurisdiction. This prospect of tracking those separate jurisdictional differences on the netting sets is probably going to be difficult for some counterparties, and is an opportunity for parties to misalign the transactions that they include in a calculation and could lead to disputes. And as you mentioned a moment ago, there's also this question of whether it also could interfere with the ability for you to apply substitute compliance, because you might be coming into scope of the initial margin requirements in one jurisdiction 4 months differently, time frame-wise, from another jurisdiction. So hopefully the U.S. will consider aligning with the BCBSI OSCO framework on the compliance dates, and we would want the EU and Switzerland to do that as well. That will make it much more streamlined for market participants to monitor any changes to those transactions and parties which are in scope for initial margin. If for some reason the U.S. And EU don't align with the compliance periods, then at least we would ask that the U.S. align with the EU and Switzerland in terms of the date for the first post-phase-in compliance period, meaning phase 6 commences September 1st, which means if you switch to a January 1st date in the U.S., it's only 4 months later that you now potentially have a shift again for parties coming in or out of scope after only 4 months. Whereas in the EU and Switzerland, they are going to bump that, right? Their perspective is that that would not happen until the following year. So essentially you have a 16-month phase 6 before you would apply changes. So it would be very beneficial to have this be aligned at least across the EU, Switzerland, and US, to the extent the compliance periods cannot be aligned.
Thank you.
My pleasure.
Thank you. Does anyone else have any further questions or comments on this topic? All right. Gmac members, since there are no further questions or comments, is there a motion for the Gmac to adopt the subcommittee's report and recommend to the Commission that it consider adopting the report's recommendations?
This is Thane Twiggs from Cargill. I'd like to thank the subcommittee for their work and the report. And I would move that the Gmac adopt the subcommittee report and respectfully recommend to the Commission that it considers adopting the recommendations as well.
Thank you, Thane. Any second to that motion?
This is Darcy Bradbury. I'd like to second the motion and also kind of second the sentiments that have been expressed, which is that I had the privilege as a GMAC member to serve on the subcommittee, and it was very different than any other kind of comment period or similar sort of effort I've been involved in that there was a terrific diversity of perspectives on the panel, and I think Commissioner Stump and her team did a really good job of making sure that people and at firms that represent all different parts of this industry, from technology providers, brokers, asset managers, end users, custodians, and others were there, and we learned from each other. And I was very impressed also how the recommendations actually changed and improved over the period of deliberations. And so I commend them to the full committee for consideration and approval today.
Thank you, Darcy and Thane. It has been moved and properly seconded that the GMAC adopt the subcommittee's report and recommend to the Commission that it consider adopting the report's recommendations. We will now take a vote on the motion. As a point of order, a simple majority vote is necessary for the motion to pass. I will turn it over to Andre to conduct a roll call vote.
Thank you, Angie. GMAC members, when I call your name, please indicate your agreement with the motion with aye, disagreement with nay, or indicate abstain if you are abstaining from the vote. Please remember to unmute your line to indicate your vote and to remute your line once you have finished voting. I'll now conduct the roll call. Chris Allen.
Aye.
Edward Backer. Ashley Bellich.
Aye.
Don Bernardo. Darcy Bradbury.
Aye.
Maria Chiotti.
Aye.
Joe Suzuki.
I'm a no, but I appreciate everybody's great presentations and the hard work of the subcommittee.
Jim Colby. Jerry Corcoran.
Aye.
Danilo Coutinho.
Aye.
Paul Hamill.
Abstain.
Amy Hong.
Aye.
Don Horkin.
Aye.
Adam Kanzler.
Abstain.
Angie Karna.
Aye.
Robert Klein.
Aye.
Agnes Coe.
Aye.
Ben McDonald.
Abstain.
Joe Nicosia.
Aye.
Marie Posmanter.
Aye.
Tom Sexton.
Abstain.
Jessica Souls.
Aye.
Shane Twiggs.
Aye.
Superna Vedbrat.
Aye.
Masi Yamada.
Aye.
Thank you, everyone. There were 17 yes votes, 1 no vote, and 4 abstains.
Thank you, everyone. The ayes have it, and the motion has passed. The report of the Subcommittee on Margin Requirements for Non-Cleared Swaps has been adopted by the Gmac, and the Gmac recommends to the Commission that it consider adopting the report's recommendations. Chairman, Commissioner Stump, fellow commissioners, Andre, Warren, CFTC staff, and others, I really want to thank the CFTC for continuing with its important regulatory mandate, including by holding this meeting, given the challenging 100% remote scenario that you're operating under. Your mandate is incredibly important in these markets and these very challenging times. Gmac members, speakers, subcommittee members, thank you all for your active participation and valuable insights, especially given the fact that this is a phone meeting versus the much easier in-person meeting that we may be longing for. I will now turn it over to Andre to finish out the day's agenda.
Thank you, Angie. And I'm going to turn it over to the commissioners for any closing remarks, starting with Chairman Tarbert.
Thank you so much. No closing remarks from me other than to simply say that I found this incredibly helpful, beneficial, and really appreciate your viewpoints. And in the coming months, we'll be obviously taking a very close look at the report that you've adopted today to determine which, if any, recommendations the Commission may proceed on. So thank you so much.
Thank you, Chairman Tarbert. Commissioner Quinten. Commissioner Benham.
Thanks, Andre, and a quick thank you to everyone for their hard work. This was a tremendously important meeting for us to listen to, and like the chairman said, look forward to reviewing the recommendations in depth over the coming days and weeks, and taking up what we think is necessary and appropriate to stay within, obviously, the mandate of the CFTC, but working with all of our regulatees in the market to ensure safe and transparent markets. Also, I'd like to just thank Commissioner Stump for her leadership again and all those involved in putting today's meeting together. A great example of the importance of the CFTC's advisory committees and the role it plays, certainly within the context of the CFTC's mandate, but of course, with financial markets being global in nature and very interconnected, these reports have a much greater impact and effect on regulators, both domestic and international. So certainly look forward to reviewing them within the context of the Commodity Exchange Act, but I'm sure others around DC, the country, and the world will benefit from this report as well. Thank you.
Thank you, Commissioner Benham. Commissioner Berkovitz.
Thank you, and thanks to everybody, Commissioner Stump and Andre and Angie and everybody who worked hard to prepare the report and have a very informative session today. I look forward to studying the report in more detail, informed by today's discussion. Again, I'm sorry we couldn't meet in person. In the absence of an open door policy, I have an open phone policy, so I encourage anybody who is interested in discussing this further with me or my office to give us a call, and we look forward to speaking with you. And thank you, everybody, again, for an informative session.
Thank you, Commissioner Berkovitz. Commissioner Stump.
Thank you, Andre, and thanks to all the commissioners and the chairman and the members and the subcommittee members for your participation. Again, we wish we were all together in person, but I think that the meeting went remarkably well considering the circumstances. I feel as though it's even more apparent now that after our September meeting, we determined that there was a need to further explore the complex and unique challenges for Phase 5 and Phase 6 entities in the context of the margin rules. And I appreciate the hard work of the subcommittee and their really expedited attention to the matters here. The subcommittee only met for the first time in January, so they've done a remarkable job of pulling this together in a really short period of time. I also appreciate that the subject matter of this report is more relevant to certain of the committee members than others, and I appreciate that all of the members devoted time and attention to the information. Previous meetings and future meetings we've devoted to matters such as clearing and swap data, and we will continue to do so in hopes that the diversity of the committee is well utilized. As we look at the lessons learned from the recent market activities and the work of this committee, it is critically important, and I think it's quite obvious that based upon what Suyash discussed in the first presentation, that we will have lessons learned from the more recent market volatility and the pandemic. And I know that the members of this committee stand ready and willing to assist the Commission as we evaluate those going forward, and we look forward to discussing those perhaps at the next meeting. So with that, I just, again, thank everyone. I thank Andre and Warren and Carmen most especially for their diligence in trying to get all of this pulled together, and I also want to thank Suyash and Wendy for their participation. Thank you very much.
Thank you, Commissioner Stump. I also want to thank everyone for attending today's GMAC meeting. This meeting is now adjourned.